How does money appear when you take a loan at your bank? Imagine walking into your local coffee shop and seeing how a deposit there can turn into more money than what was originally put in. Banks don't just hold your cash. They create new money by issuing loans. But how does that process actually work? How do banks create money in the economy? And what does that mean for your paycheck or your rent? This isn't about magic or hidden tricks. It's about a clear system that changes how money flows around you every day. By the end, you'll see why a bank loan isn't just a promise. It's new money entering the world. What banks do: accepting deposits and making loans. Picture this. You get paid on a Friday and deposit your paycheck into your checking account. You might expect the bank to keep that exact cash locked away in a vault. But the banker, the person who runs the bank, actually keeps only a small part of your deposit on hand. The rest is lent out to others, like a coffee shop owner who needs money to buy new equipment. Even though much of your money is loaned out, your account still shows the full amount. You can spend it anytime you want. The bank is promising to give you your money on demand, while holding an IOU from the coffee shop. This system means banks do more than just store money. By lending out deposits, they create new money that people can spend. This way, the total money available in the economy grows. This unusual role of banks started hundreds of years ago in Renaissance Italy, when modern banking first took shape, with bankers like the Medici family shaping how deposits and loans worked. The start of modern banking in Renaissance Italy. But the story of banks creating money didn't begin with modern machines or digital screens. The Medici family, known for their art and power, ran one of the earliest banks. Alongside them were other banking families like the Paschi, while beyond Italy, the Fuggers and Welsers were rising as influential merchant bankers in Europe. These families didn't just hold on to people's money like a safe. Instead, they accepted deposits, money people trusted them to keep. Then they loaned out much of that money to merchants and traders. Let's say a merchant needing money to buy cloth for a new batch of clothes. The Medici Bank would lend him funds drawn from deposits made by others. This loan allowed the merchant to grow his business, pay workers, and sell more goods. The key is, the bank didn't simply pass along money from one person to another. It created new money in the form of the loan. This process expanded the amount of money circulating in the economy beyond what was physically held in coins or notes. Think of it like a local coffee shop that holds your deposit but also lends some to someone else opening a food truck down the street. The shop's cash drawer isn't just a container. It becomes a source of new spending power. The Medici's approach laid the foundation for how banks today create money through lending, not just safekeeping. But how did these early ideas survive centuries, and what shape do they take in banks still running now? That story is where the history gets even more surprising. Historic banks still operating today. Picture a bank that has been open since the year 1472. Banca Monte dei Paschi di Siena started lending money in a small city in Italy almost 550 years ago. It still operates today, with branches handing out loans to families and businesses. This bank isn't just old, it's a living link between how banks worked in the Renaissance and how they create money now. Think of it like a coffee shop that's been around since your great-great-grandparents' time, still serving the same espresso, but now with a modern espresso machine. Its long history shows that the basic idea behind banking, taking deposits and making loans, has been reliable for centuries. When you deposit cash at your local bank, it's part of a system that began with institutions like Monte dei Paschi. Alongside it, banks like the Berenberg Bank, founded in the late 1600s in Germany, and the Rothschilds banking dynasty, which rose to prominence in the 1800s, have shaped banking across Europe. These ancient banks paved the way for how money moves in today's economy. But there's a question that keeps coming up. How exactly did these early banks start creating money beyond just storing it? That's what we'll look at next. How banks create money, step by step. You just learned that banks have been around for centuries. Now, picture this. You walk into your local coffee shop with $1,000 in cash and decide to deposit it in your bank account. The bank doesn't hold on to all that cash. Instead, it keeps only $100 safely tucked away as reserves. The other $900, the bank lends it to someone else, maybe a small business owner buying new equipment. That borrower then deposits the $900 into their bank account, likely at a different bank. This second bank repeats the same process, holding back a fraction and lending out the rest. Each time, new deposit accounts appear, growing the total amount of money beyond the original $1,000. It's like a ripple effect, expanding money through lending and depositing again and again. This explains why the money you see in your bank balance can be much more than the actual cash in the bank's vaults. But how do banks decide how much to keep and how much to lend? And what stops them from lending too much? That part I'm holding back until the close. What looks like ordinary banking is only half the story. Rules that keep banks safe while creating money. Now, picture the local coffee shop again, where your $20 deposit helps fund a loan. The bank can't just lend out everything you deposit. Rules say it must keep a safety cushion. Money set aside to handle surprises, like if too many customers withdraw funds at once. After the 2008 financial crisis, these safety nets tightened. One key set of rules, called the Basel Accords, requires banks worldwide to hold a certain percentage of their total assets as capital. Think of it like a firefighter's reserve hose, kept ready in case of emergency. It might not be used daily, but without it, a small spark could turn into a blaze. These rules are not about limiting banks randomly. They aim to stop banks from lending too much, which could put the entire financial system at risk. If the bank overextends and borrowers fail to repay, that safety net helps absorb losses without causing a collapse. Without these regulations, that loan to the coffee shop might look safe until it all unravels. The question now is how recent laws have changed these rules, and what that means for banks' ability to create money next. How recent laws changed banking and money creation. Think about banks before 1999. They mostly took deposits and gave loans. Then came the Gramm, Leach, Bliley Act. It changed everything. This law let banks offer investments and insurance too. Suddenly, your bank was more than a place to save money or borrow cash. It became a one-stop shop for many financial needs. Picture you run a small bakery. Before the law, your bank helped with deposits and loans only. After the law, it could also sell insurance to protect your oven. It might even help you invest your profits. This gave banks new ways to make money. They no longer relied only on lending out your deposits. When banks sell insurance or investment products, they collect fees. They also hold assets from these sales. These assets support more lending and other financial activities. So banks have more tools to help businesses like your bakery grow. At the same time, they change how new money enters the economy. This shift means banks do more than just take deposits and make loans. They mix lending with selling financial services. The money they create now comes from this blend of activities. But what does this mixing mean for how money moves in daily life? That question leads us to what most people misunderstand about how banks actually create money. Common misunderstandings about bank money creation. But many people think banks only lend money they already have, like handing you a stack of cash sitting in their vault. Think of it like this. A small coffee shop owner applies for a $50,000 loan to buy new espresso machines. When the bank approves it, they don't pull that $50,000 from someone else's deposit on the shelves. Instead, the bank simply adds $50,000 to the coffee shop's checking account. That money didn't exist in the bank a moment before. It's new, appearing out of thin air as a deposit right when the loan is made. This means the total amount of money available in the economy just grew. The bank didn't move money, it created it. It's like a printer that makes new bills, but instead of physical cash, it creates digital money inside your account. This matters because bank lending isn't about passing around existing funds. It's a core way that new money enters the economy. So, when you see that balance jump after a loan, that's the bank crafting money from promises to pay, not from cash they hold. This challenges the old idea that banks are just middlemen. But if banks create money like this, how does the system keep it from spinning out of control? That question hints at what happens next. You asked how money appears when you take a loan at your bank. The answer is that banks create new money at that moment by adding the loan amount to your account balance. This doesn't mean they move cash from someone else's deposit to you. Instead, they record a new deposit and a matching loan as entries in their books. Knowing this changes how you see banking. It's not just holding money, but making new money through lending. Next time you open a bank statement, you can remember that your bank helped create money for the economy by extending credit to you. This simple act keeps money flowing in everyday life.